In early March 2025, silver prices declined approximately 37% from $120 per ounce to $76 within a matter of days. This represented a market capitalization reduction of approximately $3.6 trillion across global silver-related assets. The speed and magnitude of the decline raised questions about the underlying mechanisms driving price movement, the role of leverage in commodity markets, and the relationship between paper derivatives and physical metal fundamentals. This analysis examines the structural factors that may have contributed to the price decline, the conditions under which such movements occur, and the range of outcomes that different market conditions could produce going forward. The analysis will proceed in 5 parts. First, the confirmed price movement and market data. Second, the structural context explaining leverage, margin requirements, and liquidation mechanics in futures markets. Third, the divergence between paper market pricing and physical market indicators. Fourth, the regional pricing differences that persisted during the decline. Fifth, scenario mapping based on different paths for liquidity conditions, physical demand, and institutional positioning. Silver prices reached approximately $120 per ounce in late February or early March 2025, before declining to approximately $76 per ounce within several days. The decline represented a 37% reduction from the peak. Market capitalization across silver-related assets, including mining equities, ETFs, and derivative positions, declined by an estimated $3.6 trillion during this period. The Chicago Mercantile Exchange increased margin requirements for silver futures contracts during this timeframe. Margin requirements determine the amount of capital traders must maintain relative to their position size. When exchanges raise margins, traders with leveraged positions must either deposit additional funds or reduce position size. London lease rates for borrowing physical silver remained elevated during and after the price decline. Lease rates reflect the cost of borrowing metal from holders willing to lend it. Rising lease rates typically indicate increased demand for physical borrowing or reduced willingness among holders to lend metal. Shanghai silver prices maintained a premium relative to Western market prices during the decline, though the absolute premium amount fluctuated. Physical silver premiums in retail markets persisted above historical averages during this period. ETF flows showed mixed patterns, with some funds experiencing outflows while others reported continued inflows or stable holdings. Registered inventory at COMEX showed movements both into and out of deliverable status during the decline period. To understand the price movement, it is necessary to examine how leverage and margin requirements function in commodity futures markets. Futures contracts allow participants to control large quantities of a commodity with a fraction of the total value as margin. For example, if margin requirements are 10%, a trader can control $1 million worth of silver with $100,000 in capital. This leverage magnifies both gains and losses. When prices move favorably, leveraged positions generate returns that exceed the percentage price change. However, when prices move adversely, losses also multiply. If losses reduce account equity below maintenance margin requirements, the broker issues a margin call demanding additional funds. If the trader cannot meet the margin call, the broker liquidates positions to bring the account back into compliance. Exchanges adjust margin requirements based on market volatility and risk assessments. During periods of high volatility or rapid price changes, exchanges may increase margins to protect the clearing system from default risk. When margin requirements rise, existing positions suddenly require more capital. Traders unable or unwilling to post additional margin must reduce position size by selling contracts. The mechanics of forced liquidation create feedback loops under certain conditions. When a large number of leveraged long positions face margin calls simultaneously, selling pressure increases. This additional selling pushes prices lower, which triggers more margin calls on remaining leveraged positions. If stop-loss orders are concentrated at specific price levels, the downward movement accelerates as these orders execute automatically. Algorithmic trading systems may amplify this dynamic. Many trading algorithms monitor price momentum and volatility. When rapid downward movement occurs, momentum-following algorithms generate sell signals, adding to selling pressure. High-frequency trading systems that provide liquidity may widen bid-ask spreads or reduce position limits during volatile periods, further reducing market depth and increasing price impact per unit of selling. The liquidation cascade represents a liquidity event rather than a fundamental revaluation. In a fundamental revaluation, new information about supply, demand, or economic conditions causes participants to reassess the equilibrium price. In a liquidity event, forced selling driven by leverage and margin mechanics dominates price action regardless of fundamental conditions. Several indicators suggest the March decline contained significant liquidity-driven components. The speed of the decline exceeded typical fundamental adjustment patterns. News events cited in some market commentary, such as employment data or inflation reports, did not represent substantial changes to silver's supply-demand fundamentals. The persistence of elevated lease rates and physical premiums during the paper price decline indicates divergence between derivative market pricing and physical market conditions. Physical market indicators behave differently than paper prices during the decline. Lease rates measure the annualized cost of borrowing physical metal. These rates are determined by the supply of metal available for lending and the demand from borrowers who need physical delivery for industrial use or arbitrage. Rising lease rates during a paper price collapse suggest physical metal remains in demand even as futures prices decline. This pattern indicates the paper price decline reflects derivative market liquidation rather than reduced physical demand. Physical premiums in retail and wholesale markets also persisted. Dealers reported that buy-sell spreads widened during the decline, with physical metal selling at premiums to futures prices. This premium structure indicates retail and smaller institutional buyers continued purchasing physical metal despite lower paper prices. The premium reflects either persistent physical demand, concerns about future availability, or opportunistic accumulation by buyers who view the decline as temporary. ETF flows provide mixed signals during such events. Some ETFs experienced redemptions as holders liquidated positions, adding to selling pressure. However, other ETFs reported stable or growing physical holdings, suggesting certain institutional participants maintained or increased physical exposure. The divergence in ETF flows may reflect different investor bases, with retail investors more likely to liquidate during volatility, while longer-term institutional holders maintain positions. The Shanghai market maintained a premium to Western prices throughout the decline, though the premium narrowed temporarily during the most volatile periods before re-widening. This persistent premium indicates Chinese market participants continued valuing physical silver above Western paper prices. Several factors may contribute to this premium, including capital controls limiting arbitrage flows, stronger physical demand in Asian markets, strategic accumulation policies, or reduced trust in paper settlement mechanisms. The divergence between Shanghai and Western prices creates theoretical arbitrage opportunities. Traders could purchase silver in Western markets at $76 and sell in Shanghai at a premium, capturing the spread. The fact that this arbitrage did not eliminate the premium suggests obstacles to the arbitrage mechanism. These obstacles may include capital controls restricting fund transfers, logistical challenges moving physical metal, regulatory barriers to cross-border trading, or insufficient confidence that Western contracts can be settled in physical metal. The institutional response to the decline varied across participant types. Some large holders reportedly increased physical accumulation during the price decline, treating the lower prices as an acquisition opportunity. This behavior pattern appears in other commodity markets when sophisticated participants distinguish between liquidity-driven price moves and fundamental deterioration. If institutional buyers believe the decline results from forced liquidation rather than weakening fundamentals, lower prices represent discounts relative to their assessment of fair value. Evidence for this accumulation pattern includes stable or growing physical holdings at certain ETFs, reported vault movements into registered status after initial outflows, and the persistence of physical premiums despite lower paper prices. However, direct data on institutional positioning is limited, and accumulation patterns remain partially unclear. The role of margin increases in triggering the decline merits examination. When CME raised margin requirements, leveraged long positions suddenly required more capital. Traders faced a choice between posting additional margin or reducing positions. Those unable or unwilling to add capital sold contracts, creating downward pressure. The timing of margin increases relative to the price decline suggests a causal relationship, though multiple factors likely contributed. Exchanges increase margins to protect the clearing system. If volatility rises substantially, default risk increases because leveraged positions can generate losses exceeding account equity. By raising margins, exchanges reduce leverage ratios and decrease the probability that losses will exceed available collateral. However, margin increases can also trigger liquidation cascades if implemented during already volatile conditions. The March decline followed a period of rapid price appreciation to $120. During rising markets, leveraged long positions proliferate as momentum attracts speculative capital. If leverage builds to extreme levels, the market becomes vulnerable to sharp reversals when liquidation begins. The decline from $120 to $76 may represent a deleveraging event where excess speculative positions were flushed from the market. Multiple scenarios exist for how conditions may evolve depending on physical demand, institutional positioning, and market structure adjustments. Scenario A involves market stabilization and gradual recovery. In this scenario, the forced liquidation completes and selling pressure exhausts itself. Physical demand remains stable or increases as industrial users and strategic buyers accumulate at lower prices. Institutional participants who increased physical holdings during the decline provide support. Leverage ratios decline to more sustainable levels, reducing vulnerability to future liquidation cascades. Lease rates normalize as physical borrowing demand is met and lenders return to the market. The Shanghai premium compresses as arbitrage flows resume. Prices recover from the $76 low but stabilize below the $120 peak. Market structure becomes less dependent on leverage, reducing volatility. Conditions required for Scenario A include completion of margin call-driven liquidation, no additional negative liquidity shocks, sustained physical demand from industrial or strategic buyers, and confidence that physical settlement remains viable. Indicators include declining volatility, narrowing bid-ask spreads, stabilizing lease rates, reducing physical premiums, and steady or growing registered inventory. Scenario B involves continued weakness and further decline. In this scenario, the price decline triggers broader risk aversion in commodity markets. Additional leveraged positions in other metals or commodities face liquidation, creating spillover effects. Physical demand weakens as high prices from the $120 peak slow industrial consumption, and users draw down inventory rather than purchasing new supply. Institutional accumulation proves insufficient to offset liquidation pressure. Retail investors who purchased at higher prices capitulate, adding to selling. Technical support levels fail, triggering additional stop-loss orders. Prices decline below $76 towards $60,065 levels. Lease rates decline as physical demand softens. The Shanghai premium disappears as regional demand aligns with lower global prices. Conditions required for Scenario B include contagion to other commodity markets, weakening industrial demand due to economic slowdown, failure of institutional buying to provide support, and continued forced liquidation from remaining leveraged positions. Indicators include breaking of technical support levels, declining lease rates, disappearing physical premiums, falling industrial production data, and continued ETF outflows. Scenario C involves rapid recovery and potential squeeze. In this scenario, aggressive institutional accumulation during the decline removes available physical supply. Industrial users who delayed purchases accelerate procurement, concerned about future availability. Short sellers who profited from the decline face difficulty covering positions as physical metal becomes scarce. Lease rates spike as borrowing demand overwhelms available supply. The Shanghai premium widens substantially as Asian buyers compete aggressively. Large delivery demands against futures contracts strain COMEX registered inventory. Exchanges face operational challenges settling contracts in physical metal. Prices recover rapidly, potentially exceeding the previous $120 peak. Volatility remains elevated, but with upward bias. Conditions required for Scenario C include substantial institutional physical buying, persistent industrial demand, short covering pressure, continued tightness in physical markets, and large delivery demands against futures. Indicators include spiking lease rates, widening physical premiums, declining registered inventory, rising open interest combined with falling inventory, and aggressive price recovery on high volume. The implications vary across participants. Leveraged long positions that survive the decline without liquidation face mark-to-market losses but retain exposure to potential recovery. Those liquidated during the decline realized losses and lost their positions before any potential rebound. Short sellers who correctly anticipated the decline face decisions about covering positions versus maintaining shorts in case of further weakness. Physical holders who did not use leverage experienced value decline in dollar terms but retained their metal. If they view silver as long-term value store or industrial input, short-term price volatility may not affect their holding strategy. Those who accumulated additional physical during the decline at $76 levels obtained metal at substantial discounts relative to the $120 peak. Industrial users with silver-intensive manufacturing face input cost uncertainty. The price decline reduces immediate costs but creates questions about future supply availability and price stability. Users must decide whether to increase inventory at lower prices or maintain minimal holdings in anticipation of further declines. ETF investors experienced varying outcomes depending on the specific fund structure and their own liquidation decisions. Those who sold during the decline locked in losses. Those who maintained positions retain exposure to future price movements. Physical-backed ETFs continued holding metal regardless of price, while synthetic ETFs may have faced different dynamics depending on their derivative structures. What remains uncertain includes the total amount of leveraged positioning that has been liquidated versus remaining, the scale and duration of institutional physical accumulation, the trajectory of industrial demand in coming months, whether additional margin increases may occur, and how upcoming macroeconomic data releases may affect commodity market sentiment. Key variables to monitor include daily margin requirement levels at major exchanges, lease rate movements in London and other markets, physical premium levels in retail and wholesale channels, registered inventory changes at COMEX and other exchanges, ETF flow data, the Shanghai premium trajectory, and volatility levels. Changes in these indicators will signal which scenario is unfolding. The March decline demonstrates the impact of leverage and forced liquidation on commodity prices. When substantial leveraged positioning exists in a market, rapid price movements can trigger liquidation cascades that drive prices beyond levels justified by fundamental supply-demand conditions. The divergence between paper market pricing and physical market indicators suggests the decline resulted primarily from derivative market mechanics rather than deterioration in physical fundamentals. To summarize the confirmed elements, silver declined approximately 37% from $120 to $76 in early March 2025. CME increased margin requirements during this period. Market capitalization declined by approximately $3.6 trillion. London lease rates remained elevated during the decline. Shanghai maintained a premium to Western prices. Physical premiums persisted in retail markets. ETF flows showed mixed patterns, with some funds seeing outflows and others maintaining holdings. What remains uncertain includes the extent of remaining leveraged positions. institutional accumulation levels during the decline, near-term industrial demand trajectory, and whether physical market tightness will reassert influence over paper pricing. The variables that matter most include margin requirement levels, lease rate direction, physical premium sustainability, registered inventory changes, and the persistence or compression of regional price differentials. This event illustrates the interaction between leveraged derivative markets and physical commodity fundamentals. We will continue tracking confirmed developments in market structure, physical indicators, and price movements across regions.